Happy Friday. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Oil is headed for another weekly gain as the U.S. weighs a potential move on Iran's key export hub, Kharg Island.
War-driven turbulence meets triple witching. Wall Street equity traders brace for more volatility today. Maybe the options expiry will matter.
And FedEx delivers an earnings beat as investors look for clues on the Iran war's impact on corporate America. I find it hard to believe that the expiry is going to really make a difference, because in my 26-year career here, I've really never seen triple witching matter.
But I've become, as you know, obsessed in recent days with this idea that it will matter this time because the market hasn't moved much, because a lot of people are hedged. So maybe when those hedges start to roll over, it will matter.
I could be wrong.
I don't know. You know? We'll see what happens. Yeah. It's a long day, a lot to play for today. We're looking at FedEx shares in the meantime in the pre-market, up 7 1/3%. It boosted its full-year forecast as its network restructuring takes shape. It says the war in Iran won't have a material impact on the business for now, but Matt, they go on to say that it might have a wider economic impact, which would obviously impact FedEx.
Yeah, and higher energy prices are moving stocks. Take a look at the producers themselves. They closed at all-time highs, and the energy sector. Dani, I was showing you a Bloomberg screen earlier that shows the energy stocks are really one of the only two gainers of all 25 industry groups in the S&P 500. Software and services also showing a little gain, but energy has absolutely crushed.
It certainly has, and the developments keep on coming. Axios reporting that the Trump administration is weighing plans to take control of Iran's Kharg Island, a critical oil export hub. The move is aimed at reopening the Strait of Hormuz. Let's get the latest with Bloomberg Washington correspondent Tyler Kendall, who's at the White House. Tyler, what could this look like?
Hey, Dani. Well, at this point, there are still some questions here about exactly how a potential operation would take place, though Axios is reporting that the U.S. would look to degrade Iran's military capabilities around the Strait of Hormuz further before launching any potential operation there. This comes as the disruptions in the Strait continue, and we heard the U.S. Treasury Secretary Scott Bessent just yesterday suggest in an interview that Kharg Island could become a U.S. asset. In his words, just for context here, Kharg Island ships out about 90% of Iranian crude exports, and imagery analyzed by Bloomberg shows that for the most part, those loadings have continued unabated. Now, there's a few different things that we could be watching here. Of course, we know that last Friday, the U.S. had confirmed that it did hit military targets on Kharg Island, prompting President Trump at the time to say, quote, "We can take the island anytime we want." The U.S. has sent additional assets to the region recently, including the closely watched 31st Marine Expeditionary Unit, a 2,400-troop force that specializes in amphibious operations, amid speculation that this could be used in any potential takeover or blockade of the island. But again, none of this is confirmed at the moment, but it does come as yesterday President Trump said that he is not going to deploy ground troops, though in the same breath told reporters in the room that he wouldn't tell them if he was. And Matt and Dani, the backdrop here is that this White House and Israel are now vowing not to go after energy infrastructure, but we still saw Iran overnight press ahead with attacks against regional allies, including Kuwait, the UAE, and Saudi Arabia.
All right. I know also that Takaichi of Japan was with the president yesterday because of his Pearl Harbor joke. Everybody, I think, knows already. But what about the possibility of allies working with us? Because President Trump initially called for allies to work with us and then said, you know what, we don't need you anyway, forget about it. But then he called for them again to come work with us. Like, how is that all panning out?
Well, Matt, we actually saw yesterday, after Takaichi's visit here to the White House, 7 allies, including Japan, release a joint statement saying that they would be supportive of a potential coalition to help secure the Strait of Hormuz. But it didn't really go into details in exactly what they would be willing to deploy in terms of assets and when, as we've heard a lot of our allies outline, that they would need to see a ceasefire in place first before they looked to help secure the Strait of Hormuz. We heard from the Israeli Prime Minister Benjamin Netanyahu in a press briefing yesterday saying that Israel is going to start to help attempt the U.S. to help the U.S. attempt to reopen the strait. But all of this is still, of course, fluid. President Trump has reiterated his criticism yesterday, saying Japan stepped up to the plate, but NATO allies haven't. Not totally clear, again, what Japan is providing here, though President Trump did say behind closed doors they would talk about the country's mine-sweeping capabilities.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there reporting live from the White House. Now, oil is heading for another weekly gain, with Brent crude up 50% in the month of March so far. Joining us is Alaric Nightingale, who leads our oil trading coverage in Europe. So, Alaric, we initially had seen, big gains and then big drops. Every time something bad would happen in the Middle East, you'd have a huge gain, and then President Trump would come out and say, don't worry, this is going to be over very quickly, and we're not going to hit energy assets, and it would come down. Are we now stabilizing at this higher level around 110?
That's a great question. I think the reality in the wider oil market, the stuff that's behind futures, does show a much more bullish feeling. The price of fuels, as you know, has been surging far faster than crude. And if you look at the differentials for there are hundreds of different crude grades in the world, and those prices, the ones that refineries have to actually buy, are really surging. The premiums are really going up, which tells you how tight the actual market is, the underlying market below the kind of futures price. So there is a bullishness out there. And until we see clear kind of signs of things calming down, there's plenty of reasons to think that things won't ease off.
It's incredible to look at, for example, the price of crude priced from Dubai at something like $160 a barrel, Alaric. How do futures curves look further out, the discrepancy between the physical and the futures market? Because one would have to assume, with the knowledge that Iran can clearly control the Strait of Hormuz with cheap drones, surely that there's some more risk premium priced in further out.
I think the most important thing that futures curves tell you is that right now the market is extremely tight. I mean, that's such an obvious statement given what's happened, but the premiums to get barrels now, the premiums to get physical barrels are really, really high. So that's the most obvious and certain thing. Beyond that, everybody's waiting to see how this plays out. Everyone's waiting to see how this settles down. And that's the critical thing. You get all these kind of price forecasts that are based on an if it goes on till the end of March, if it goes on till the end of April, if it goes into May. Well, tell me the answer to that, and I'll tell you, a better idea of what price are going to do. The truth is nobody knows.
We do see, I type CO1 commodity to look at Brent, CL1 commodity on the Bloomberg to look at NYMEX, WTI, because obviously that's the U.S. contract that we focus on. And that contract is down for the week. We're only trading at $95 and Brent's at $110, a $15 delta there. Is the U.S. much more insulated to this, Alaric, than the rest of the world?
I think there's a degree of the US being insulated from what's going on in the Middle East, yes. The idea that the US could intervene in markets, I think, has probably kind of got into some of the market's mindset. And maybe if there is an intervention, or people think that there might be an intervention, that would be in US crude. And maybe that's just feeding the psyche. I'm not for 1 second saying that there's intervention. I'm saying that traders' psyche might be affected by that very thought. So,
well, the Treasury Secretary floated that idea yesterday, right? That we could release more barrels from our own strategic petroleum reserve.
Right. No, I'm talking about intervention in terms of futures markets and this idea,
okay, yes.
which the administration has frequently talked about not doing.
Yes.
But nevertheless, every time they say they're not doing it, people, maybe it gets into the market psyche. So it's a good way of talking the market down, just saying they're not doing it almost, has a reverse effect.
Yeah, I have to say, was it last weekend? Basically, it was the talk of the town that there had been these huge amounts of futures traded. Maybe it was the Treasury. Alaric, thank you so much for joining us. That's Bloomberg's Alaric Nightingale. Elsewhere, FedEx does not expect the war in the Middle East to have a direct material impact on its business. It did, though, warn of broader consequences to the overall market. Shares surging this morning, up 6.5%, raising its full-year profit forecast. Bloomberg's Matthew Griffin reports on FedEx, joins us now. Matthew, what was your takeaway?
Well, Dani, I, like pretty much everyone else on Wall Street had my eyes on what the company would say about the Middle East. You just got at it there. It seems like the tone was relatively positive right now. Of course, no one can predict the outcome of this conflict or how long it will last, but the company's chief executive did say that so far they're seeing their normal demand trends in the month of March. So that's the beginning of their fourth fiscal quarter. That's certainly heartening for investors, but also in the face of all of that uncertainty, FedEx's results and outlook were really strong. They now see their adjusted earnings per share in the range of $19.30 to $20.10. That's up from no more than $19, well above estimates. And they also recorded a adjusted earnings per share beat in the third quarter and growth in that metric when Wall Street was expecting a decline. So the core business seems like it's strong as well.
All right, Matt, thanks so much for joining us. Matthew Griven there covering FedEx for us on the BN side. Quick check on what's going on in markets this morning. We're looking at futures down 1/3 of 1%. NASDAQ futures off 0.5% right now. And the U.S. 2-year yield pushing up, the 10-year yield, by the way, pushing higher as well. We do see right now, if you look at the oil sector, that's Brent crude off a little bit to $108 a barrel. NYMEX is also off just a little bit to less than $95 a barrel. So little bit of bullishness coming out of the oil patch. Let's get a check on some of the individual stock movers that we're watching. Unilever is in talks to sell its $33 billion food business to McCormick. That's the spices company, as it divests and focuses on personal care products. So looking to sell Hellmann's mayonnaise to McCormick Spices.
And I can promise you that both those shares are up. We're looking at Planet Labs now, so I might as well tell you about that. Those shares are up 23%, surging after revenue and its 2027 outlook topped estimates.
Hellmann's mayonnaise.
You're still on that, huh?
Novartis agreed to buy an experimental breast cancer drug from Synovation Therapeutics for as much as $3 billion. Novartis is up 1%.
QP mayonnaise, by the way, is far superior.
What's that? QP mayonnaise?
It's Japanese mayonnaise, and it uses, I believe the difference is it uses the whole egg in it. It's amazing. It's far superior to Hellmann's.
As most people from the great state of Ohio, I've never had any other kind of mayonnaise than Hellmann's, and I intend to keep it that way.
Give it a try. It's pretty good. Okay, coming up, a wild story. Supermicro tanking this morning. Its co-founder is charged with illegally sending AI technology to China. We're going to have the details for you next, right here on Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. Janus Henderson is facing internal revolt as teams overseeing 90% of assets oppose Victory Capital's takeover bid. Dozens of managers are threatening to quit, warning of cultural damage and client losses. Employees are expressing support for the firm's current leadership, as well as an earlier bid by its top shareholder, Trian. Goldman Sachs CEO David Solomon says a rebound in deal making, along with growth in wealth and alternatives, could lift returns above targets. In a shareholder letter, he says the firm is aiming for up to a 19% returns in asset and wealth management while expanding AI across key operations. And for all the latest deal news, by the way, you can tune in to Dani's Deals Show. That's every Wednesday at noon, New York time. U.S. prosecutors are charging a Supermicro co-founder with secretly funneling billions in Nvidia AI servers to China in a violation of U.S. export controls. 2 suspects have been arrested and 1 remains at large, making it the biggest AI chip smuggling case yet. Supermicro is a key assembler of Nvidia's most advanced AI systems. Dani?
Let's bring in Bloomberg Tech co-host Caroline Hyde on this, because Caroline, this is a wild story. This is pretty crazy. I love the surveillance footage they have of them with like hair blow dryers, changing and putting dummy serial numbers on this. What exactly happened?
Well, the dummies is all about making sure that this company one in Southeast Asia still seemed to have servers that had been shipped to it, when actually they'd already been siphoned off to China. This is an accusation that is aimed at the co-founder of the business who co-founded Supermicro back in 1993. He's been on the board of the company, but as well as another executive based in Taiwan, as well as a contractor, that basically they were making up to $2.5 billion worth of sales of servers stuffed full of H200s, B200 Nvidia chips, and not actually selling them to a Southeast Asian company, Company One as it's named, but in fact it was going to there and then on to a Chinese end demand. And look, at the moment we're waiting to hear back from those that are charged, but the charges really are that they were avoiding these export controls, that there was conspiracy in some way to be, well, smuggling goods from the US as well as defrauding the US. This could be 20 years plus 5 years plus 5 years if they are indeed convicted. And we've seen other arrests happen, but all of this is because since 2022, you haven't been able to ship cleanly Nvidia chips over to China. You've got to be getting some more export licenses, and controls have been put in place to stop exactly this. And then we even have documentation that's, of course, there's the accusation that they were making up documents to really put all the wool over the eyes of their own compliance department. And that's why it's notable that a lot of the analysts here are saying, look, the actual defendant is not the company. But what does this mean in terms of Nvidia wanting to do business with this company long term? How much does it once again just implicate and skirmish the name of Supermicro, which I might add has already had plenty of
governance issues. I was just going to say,
already.
I mean, this is the same company that had accounting problems, right? And had its auditor say, you know what?
I quit.
We quit. We don't want to have anything to do with these books. And for months, they couldn't even find another company that would agree to audit their books. Like, this can't be a surprise.
I think maybe if you're a long-term holder of Supermicro, you're up for a bit of volatility. And like at that point, the shares dropped 60%. Today, Matt, they could fall off a cliff by a quarter of their entire market cap. That's what, $4 billion of about $18 billion company. You're used to perhaps this company sailing close to the winds, but never have we seen such a clear and evident accusation and charge of companies trying to get around what is the United States' focus on national security, on stopping Nvidia chips getting into Chinese hands, and the AI issues that come into play with that. Really, this is at the moment an allegation, and we know that one still remains on the run. He's the Taiwanese executive for Supermicro, but the contractor and indeed the co-founder have been brought to bear, have been charged. I want to see how this court continues.
For what it's worth, Supermicro, their statement this morning, Supermicro maintains a robust compliance program and is committed to full adherence of all applicable U.S. exports and re-export control laws and regulations. Caroline, what about the political context of this? Because this is also a moment where, yes, this is an administration that is deeply occupied by war, but still these concerns of what technology goes to China, what doesn't, the relationships, what Nvidia chips get exported to China constantly is in the headlines.
Another issue of contention, I'm sure, when indeed President Xi does meet with President Trump and what they discuss. This is a US server maker allegedly trying to get tech over to China. So this is an embarrassment in many ways to the US government, who doesn't want to see what are companies that are integral to the AI data center wave. These sorts of pieces of equipment, this is a direct rival to Foxconn. This is actually a US-made company that makes servers in the United States. Yes, then it's shipped over to Taiwan and then over into other global countries, but this is US-made. This is important for the build-out of data centers. It's not a good look if they're being charged by your own government for potentially, well, accusations that they're defrauding and that they're smuggling.
All right, it's interesting. You know, the SEC problems with accounting happened before this investigation even started. So they've had first the SEC issues, then the NASDAQ delisting. This investigation started in 2022 after all of that stuff. Then you had the Hindenburg report. Then you had EY leaving. So they've had just a slew of issues. I guess you're right. Volatility is definitely in store, regardless of whether the allegations are proven true or not. Bloomberg's Caroline Hyde co-anchors Bloomberg Tech. You can catch her program every weekday at 11 a.m., including today. She'll be on with Ed Ludlow.
I will. He's
with
back.
Ed. Ed is back. All right, coming up, Smead was bullish on oil stocks long before the Iran war, and he joins us next for a bit of a victory lap, but we'll talk about what else he's holding and if he's going to make any changes now. This is Bloomberg Open Interest.
What we've seen, I think, really is that oil matters more than anybody recognized, the dependency of the world on it, and the bridge that exists there. The opportunities seem to be pretty clear here, in our view, and that is let the diplomacy and the military do what they need to do, and in the meantime, prepare for a more positive outcome than is being projected at the present time.
John Stolfus on Bloomberg Surveillance. Joining us now is Smead Capital CEO and Portfolio Manager Cole Smead. Cole, thanks so much for being in the studio today. Great to see you. I got to say, you have quite a bit of oil stocks, energy companies in your portfolio. I'm sure you weren't thinking that this would be the thing that really gives them a lift. How are you thinking about that portion? And take a victory lap if you would so like to.
Well, the hero in the story is the investors of Smead Capital Management. It's not us. But as Mae West once said, too much of a good thing could be wonderful. Okay. And so I say that, I think of, the discussions we've had over the last year on this show where, I think last spring, okay? Are we going to have a recession, tariff situation, OPEC plus supply increases? And everyone sat down and said, the future is so knowable. This is going to be a terrible industry. And here we wake up within 12 months. They're paying $170 in Dubai today for oil, the highest price in the history of the world. Where was that in the cards 12 months ago? And so I think what it really points out, we're seeing an inflection. There's 3%. We started with 3% of the S&P 500 in energy. What are we learning very quickly? A, the world needs this commodity. And B, we are in a very different place in America, and really North America today. Yom Kippur, it was in 1973. It lasted 30 days. The effects lasted for the rest of the decade. But America did not have its own energy supply. We were not really a producer of oil. We are the largest oil producing nation in America today. We have this awesome neighbor to the north that provides us very secure, cheap Western Canada Select. And what a great place to be when there's problems elsewhere in the world. Now, are we going to have to pay more for our oil and our gas? Yes. But if you go out and say, what was $147 a barrel in 2008? Yep. In today's dollars, it's $218, and that doesn't even start to think about fuel consumption, right, which has got a lot better. So the idea that this is going to stop the economy, cause demand destruction, that's crazy.
Cole, we're going to have a deeper conversation with you because it's also complex, right? Canada has their oil. We have ours. We're looking at Brent. You talk about what they're paying in the Middle East, and then we need distillates. We need to refine. So Cole Smead is going to give us a little lesson on the energy patch. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are down here across the board. Not huge drops, but a lot of risk managers may not want to go into the weekend holding right now. S&P futures down a quarter. NASDAQ futures down a third. You can see some IPOs. Janus Living ringing the bell at the New York Stock Exchange. They sold shares at the top of the range yesterday, so it's a happy group down there. And then Horizon Quantum ringing the bell down at the NASDAQ market site.
Oh, I love this kid in the front. He's catching the confetti.
I like it when they bring their kids. You know what?
Me too.
It's a bucket list event. It's the kind of thing that you tell your kids, your grandchildren about. I rang the bell at the stock exchange at the open, right? Yeah. You don't really tell them if you rang the bell at the close. It's the open that matters.
Yes, I like that. I like that a lot. Well, here at the open, Matt, I'm looking at shares of FedEx. They are up 5.3%, moving around a little bit. They boosted their full year forecast as its network restructuring takes shape. They also talked about the war in Iran on the call, saying that it won't have a material impact on the business for now, but they did flag, look, with the volatility, especially in energy prices, this could have wider economic ramifications.
Speaking of energy, let's take a look at some of these producers that Cole has in his portfolio. Actually, I'm going to talk to him about what he has in his portfolio. I don't know that these are the names, but Chevron, ConocoPhillips, EQT, all looking at gains today. They're mild, and you can see Chevron turning down, but it's in a down market. Let's get back to Smead Capital CEO, Portfolio Manager Cole Smead. It's, as I say, a complicated patch, right? Because we've got NYMEX trading at 95. Brent was up to 120 yesterday morning. Now it's at 110, but there's a big delta there now. I know that not all of our refiners are set up for WTI. How do you know what to buy? I mean, obviously you spend a lot of time in this industry.
Yeah, so we only own the producers. Now, why? Oxy recently sold off OxyChem, okay? The reason for that is you make the highest returns on capital upstream, and then as you go downstream, they're attractive returns, can be, but at the same time, they're really a fixed return relative to the upstream, okay? And so anytime you can go upstream at attractive prices, that's where the highest returns on capital are. So here's how I think about today. Are we going to see a bid and returns pick up across the space? Yes. Why? Because upstream returns are climbing massively. I mean, if you compare where we started in the year to where these companies are making free cash right now, to say they're doing 2 to 3 times the free cash flow may be an understatement on a daily accrual for cash basis. And so as you're watching these stocks go up, say 40, 50, 60%, relative to where the returns on capital have gone, that's not that high. Now, I'll add one more thing. We are in a world where we just watched the SaaS apocalypse go on, and those are asset-light, high-return businesses, supposedly. Well, right now, the most capital-intensive industry, like energy, is out producing higher returns on capital than SaaS businesses, and nobody still owns them.
But by the way, which producers? You're talking about the major integrated oil producers. So which ones do you own?
Yeah, so our U.S. side, our largest holding, both portfolios of ours is Cenovus, oil sands producer. They took out Meg last summer. They've already announced in that Meg acquisition, Meg was producing about 108,000 barrels. They're going to do 150 in a couple of years. Meg was bought for about $54,000 per flowing barrel as of November. That was at lower prices. So what is the value per flowing barrel that the market should be implying? As of these prices, we know it's higher. Is it 50% higher? Is it 100% higher? I point that out because it kind of gives you a nice comp for the market. Go look at APA. APA was $14 last April. We're talking about a stock at 37 right now. Okay? And so that's how quickly the prices have shifted, because ultimately the Permian producers were left in this, you don't have much inventory, Canada's going to be marginally more attractive, and now these Permian producers are being bid because ultimately the word is torque, right? Where is the price of oil moving the operating leverage in a business in a way that causes free cash flow to explode? And where that is the best is in the non-majors. Okay, so you're an independent producer like an APA. I will not be surprised to see more of these independents get picked up by the majors, because that's where free cash flow is exploding. All stock deals is what you're going to see. I'll throw out one other idea to you. Who's been really explaining this and really thinking about this cerebrally? Adam Watrous, who runs Strathcona Resources, ticker is SCR. He's been explaining how long-term bullish he is in the space. He's who put Meg in play. He didn't win it, but they're a producer that came from going public in 23, stock sitting at an all-time high after they just handed $10 of cash off late last year. And again, I know that name. You guys have never heard of that name. And that's pretty common in the energy business right now, because investors have had no interest in the space.
In order for this play to really accelerate, do you need to have elevated oil prices? You're describing a structural shift, but to get max bullish on this, what needs to develop in the Middle East, and what needs to happen to oil and energy prices? Yeah,
dogs chase cars and people chase stocks. That's never going to change in my lifetime. Okay, and that's just the nature of the beast. So, the capital cycle theory argues that, you get low prices, people cut supply. That's what we've just been through, right? We were watching, I think we own Diamondback Energy, for example, in our U.S. portfolio. Their CEO was talking about, look at the prices, and by the way, we are going to be reducing our supply and reducing our working capital and reducing our capex. So what's going on is there is no incremental capex going on, and what's happening to the returns of these businesses despite that? They're exploding in returns, okay? It's going to take a while for that to go away. The initial reaction this 2 or 3 weeks ago was like, oh, fade this. This is not that big of a deal. Kind of like Veni, as I like to call it, Venezuela. Veni was not that big of a deal, right? Oh, this is probably going to be fixed, and Trump's going to do something amazing. It's going to be wonderful, and oil's going to stay cheap. This is far more of a long-term conflict, a structural impediment.
So you don't see, even if we have, taco tomorrow, you don't think that Brent is going back to $70 a barrel quick?
Well, you got to get Iran to taco out too. That's the issue here. Iran's looking and saying, you know what, we're the tail that wags the dog right now. They're shipping oil. Everyone isn't. That's who's been moving, oil out of the Strait of Hormuz is Iran. Here's one other thing. Look at the futures market. I said the physical market's way tighter right now, and it truly is. Why is there such a spread? The market, the stock market operators, the speculators, they in general are less concerned about this. I think markets have been very slow to adapt. We've seen this. It's been very slow. But it continues to compound where people are becoming more and more concerned. And I think the real question out of this is, what do they choose to chase? If they chase the energy stocks, you're going to have high prices, because that will incentivize the American producers and the Canadian producers to produce more oil. But the futures curve is only giving them $70, say 18 months to 2 years out. Is that enough to really get me to go in the open market, build a big project, and hedge? It's just not there. Spot is tighter than the futures, and therefore we're going to see an environment where they over-earn. And it's just great. Stock buybacks look really attractive here. Mergers look really attractive here. I mean, again, if you just if someone says, well, Cole, can you just buy the XLE? Yeah, I'm sure you could beat the S&P the next 10 years in the XLE. That's been true for a while, by the way. But how do you make the best money in this is who's going to take advantage of these circumstances, whether they're the issuer trying to acquire others or who's going to be really aggressive on their buyback the next 12 months.
By the way, as oil and energy producers have risen, banks have been on the other side of this trade. They're now in a correction. Bank of America and JP Morgan, I know you hold both of them. Both are down more than 10% year to date. I was looking at a Ned Davis research note that they cut financials to sell, saying that there's a flattening yield curve and private credit concerns. Volatility from geopolitical instability means less M&A and IPOs. How are you thinking about the sector?
Yeah, just because rich people and institutional investors went out and bought products that they shouldn't have, and they're finding out they're less liquid and not as great as they were sold, that's happened numerous times. Like, why is this new way of losing money so different than the past? Okay. Banks have been tied up in that because the idea is, like, we own Western Alliance. They're in a fight right now with Jefferies over one of these loans tied to Jefferies' asset management business. Ken Vecchione, their CEO, and Rich Handler got together for breakfast, here a little over a week ago. They sat down. They do not agree. Now, in our opinion, why is Jefferies, having that conversation? They're not really worried about the loan that they're dealing with Western Alliance. The question is, who's next in line? Okay, I think that's what's going on, and that's what people are really worried about, is who's next in line for some of the people around these alternative credit-related situations. But the idea that the economy is somehow going to get crippled, the average American, their house is the most important thing. Underwriting standards and mortgages have not changed at all. It's the underwriting.
The average American owns a ton of stocks right now.
Well,
right?
no. The average
relative
American,
to history.
The wealthy Americans own a lot of stocks, or a large amount of stocks relative to history. If you look at the Fed's, equities as a percentage of household financial assets, that's true. But the average American, the median American, doesn't own stocks. That's the catch. We have to not forget that you're in New York. You work in the finance business. I work in the finance business. You get to hang out with rich people. I get to hang out with rich people.
But isn't it a problem that that's the part of the world or the part of the American economy that's holding it up right now?
That's a myth. And I totally reject that.
Please talk more about that.
Here's what I say. That's like saying, okay, the people that had success in the past will stay there forever. I've met trust fund babies that end up with no money. That doesn't hold true. Now, you see these things where it's like, oh, the top 10% are doing half the consumption of America. Once you buy 3 houses, does the 4th really change your consumption? Once you have 4 cars, the consumption doesn't change as much as people think. So I think that's a big myth. What is big is government spending. 7% of our GDP is deficit right now. Why are we seeing this buffer all the time? Tariff tantrum, no recession. Even this, because ultimately that spending is going into Medicare and also Social Security and now defense spending. And that is such a good buffer. Now, is that problematic long term? Yeah. But do you see any politician running on austerity or fiscal, thriftness? No. So that's not going to end anytime soon. So I look at this as, go back to the 70s. Use that as an analogy again, okay? You had a technical recession early in the decade, 1970, okay? You had a real recession in 1974 when the Nifty 50 broke. We had an oil shock in 73 from, off of Yom Kippur. And we had multiple shocks during the decade. But 74 was the only real recession in the 70s. So here's my theory, okay? And I won't throw my colleagues under the bus on this one. But I think we're going to see an economy that does way better than people expect. That is different than risk assets. And that's different than equity risk or beta. Those don't look attractive. And who's going to have to pay the penance? Institutions and rich people.
Cole, I wish we had more time with you. This has been really fantastic.
I got a lot more. I'm looking forward to the commercial break because I have a lot more questions. But we don't have time. We got to go to the commercials. We have to pay our bills. Smead Capital CEO and Portfolio Manager Cole Smead. Coming up, FedEx's turnaround plans gains. The turnaround plan gains momentum. We're going to discuss that with Bloomberg Intelligence senior analyst Lee Klasko. Nobody knows more about logistics than him. This is Bloomberg Open Interest.
Let's get you some top calls. The sell side upgrades and downgrades we're following. First up, Chipotle. That gets an upgrade at Mizuho. Analysts say that sales are picking up, margins look better, and Q2 traffic could surprise. They also think that the stock's been undervalued, shares up 1%. Next up, JP Morgan makes a bullish call on shale stocks. They're upgrading Occidental Petroleum, which coal owns, by the way. Crescent Energy and SM Energy saying that the Iran conflict is keeping oil prices elevated. JP Morgan also sees U.S. producers gaining as buyers shift away from Middle East supply. Finally, HSBC, they are saying buy Chevron over Exxon because it has much less exposure to the Middle East and it makes it less risky during this current conflict. And it also still benefits from rising oil prices thanks to stronger leverage and improving cash flow from key assets. Matt, those shares up just under 1% this morning.
It's a fungible commodity. All right, FedEx does not expect the war in the Middle East to have a direct material effect on its business, but warned of broader consequences to the overall economy. Shares surged after FedEx raised its full-year profit forecast. Bloomberg Intelligence senior analyst Lee Klasko joins us here. And Lee, you know, it's fascinating as we do this interview. There's a story spiking on the Bloomberg terminal, a Business Week story about diesel prices. And the main protagonist in the lead, used to spend $6,800 a month on diesel. Now he spends $11,000, and he's a small businessman. FedEx must see the same issues, right? Diesel is probably a pretty important source of fuel in their supply chain.
Yeah, absolutely. I mean, fuel is a major expense for a large parcel carrier like FedEx. I mean, you know, you have to remember also that their individual trucks that deliver through their ground network are independent contractors, so they're not really through FedEx Corporation. But yeah, I mean, they have to deal with higher fuel costs. But, you know, they do have fuel surcharges in place that helps to recoup any rising prices and minimize the impact to margins.
What about then more generally if there is a hit to the economy, Lee? That seems to be something that FedEx was talking about, because surely they're not insulated if just overall demand starts to wane.
Yeah, I mean, we've been writing about that a lot on the Bloomberg terminal. You know, our biggest fear within the freight markets is that, you know, prolonged higher energy prices will impact the consumer. You know, we saw diesel prices recently move above $5 for the first time since 2022. And, you know, that is going to impact not only the transportation providers, but also consumers as well, because the more they're spending at the pump, the less their stuff that they're buying. And, you know, here within Bloomberg Intelligence covering the freight markets, we care about the movement of stuff. And so there's going to be less of that to move around. You know, it really depends on how long the conflict in Iran lasts for. If this is like, you know, a couple weeks and oil, quote unquote, normalizes, maybe it doesn't get to where it was before the war, but, you know, somewhere in between, you know, I think that consumers probably can handle those extra costs.
All right, Lee, great to get some time with you. I will encourage our viewers to go ahead and type BI-GO on Bloomberg terminals. That's how you access Bloomberg Intelligence, where Lee is a senior analyst and he knows more about logistics than anybody else around. Coming up, Vertiv, Lumentum, Coherent, and EchoStar are joining the S&P 500. So if those are names that are less familiar to you, you'll be hearing them more often. And we'll talk about the reshuffle of what may be the most important benchmark index in the world for stocks. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's check what's going on stocks right now. You have S&P down about 0.5%, 65.75 the level here, just about 20 minutes into the session. The Nasdaq down 0.8% as at least one big tech stock is losing ground. Let's take a look at NYMEX crude also. Coming up right now, it's been swinging back and forth. There's Brent as well. Thank you, Will. So Brent at 108.77, NYMEX at 95.77. Nvidia, the largest company in the world, off almost 1%. That's enough by itself to drag the S&P down if nobody else is moving up. Super Micro Computer, it's down 27% today. Nonetheless, even with the volatility that we've seen, it is still up like 500% in 5 years. So hold your nose and hold, I guess. Unilever right now up 1% almost. These are the ADRs. It's selling Hellmann's mayonnaise and some other foodstuffs to McCormick. I think it's a $33 billion deal. Dani can confirm that. But McCormick, as a result, down 1%. FedEx is up 1.5%. We just talked to Lee about that, a rosy outlook. And Dell Technologies, because maybe super microcomputer makes competing products. If they have problems with Johnny Law, Dell could pick up those customers, Dani.
So one, yes, confirmed. $33 billion is the price tag. So well done on that. Two, some other stocks maybe on the move. Vertiv, Lumentum, Coherent, EchoStar. They're about to enjoy the perks of index fame. Their entry into the S&P 500 today could trigger nearly $44 billion of forced buying from passive funds tied to benchmarks. Let's discuss with James Seyffert, ETF analyst for Bloomberg Intelligence. James, what sort of reshuffling are we expecting to see?
Yeah, I mean, as you mentioned, we're expecting tens of billions of dollars to be buying some of these names. Obviously, a lot of this is front run. This was announced last week, but it doesn't actually take effect in the index until really after close today. So a lot of this trading is going to happen around the close. But like I said, hedge funds, people trying to predict this, are going to be selling to those sorts of funds. There's over $10 trillion in assets that are tracking the S&P 500 alone in passive vehicles. If you include, derivatives and actively managed funds, that number goes well over 20 trillion. So, I mean, this is a lot of money that's changing hands here.
So, what typically happens to these stocks? I mean, you get added to the S&P. I know you get a boost because of that. Have you looked at the average boost? Does it matter your size and your weighting? How do you calculate these things?
Yeah, all of it matters. I mean, part of it is like, are these names in the mid-cap 400? Because if you're going from the mid-cap 400 to the S&P 500, you're going to get some selling from that index. It's much smaller than the S&P 500, but it matters. And three of those names are getting upgraded. Coherent, Lumentum, and EchoStar are in the S&P mid-cap 400, whereas Vertiv is not. So Vertiv is going to see the biggest amount of net buying. It amounts to, like, we're estimating around 27 times its average daily volume is going to be bought by these passive funds. But again, like I said, some of it has been front run. But yeah, it's a lot of money that's changing hands here.
Today is also a triple witching day, which Matt would usually turn to me and say, does it matter? Does anyone care?
I can see Michael Ball sitting off set here, so we'll ask him that question in a little bit as well.
Nodding yes, he cares. James, do you?
Yeah, I mean, it's big. I mean, not only is it just the index rebalance like we talked about. I mean, you have all these options contracts, you have futures settling. We're going to see extreme levels of volume today. It happens every triple witching, if you will. Is this as big as what we saw at the year-end 2025 triple witching? No, because the year-end contracts, there tend to be a lot more dollars trading around that, rebalancing around that. But it's still big. I mean, you're talking, I think the latest number is $5.7-ish trillion is going to be rebalancing into other options or other futures contracts. So, I mean, the answer is yes, it matters. Is it the biggest ever? No, but obviously we have a lot of things going on geopolitically, you name it.
All right, James, thanks very much. James Seyffert there from our ETF team, probably the most famous ETF team in the world, the triumvirate of analysts, James Seyffert there, Athanasios Sarafagis, and Eric Balchunas. Definitely follow their research on BI and watch their show, ETF IQ, Mondays at noon. Now, the Wall Street Journal just out with a report that 3 U.S. warships, additional warships, are on their way to the Middle East with more than 2,000 Marines being dispatched out of California. This is important, obviously, Dani, because of the talk about the potential that the U.S. will take over Kharg Island. You would imagine we would need boots on the ground in order to do that, and Israel looks fairly stretched here. We also have a post on Truth Social, President Trump putting out a message saying that without the U.S., NATO is a paper tiger. They didn't want to join the fight to stop a nuclear-powered Iran. Now that the fight is won militarily with very little danger for them, they complain about the high prices of oil and are forced to pay that, but they don't want to help open the Strait of Hormuz. He's just very angry, and he's calling basically the other NATO members cowards, he says in all caps, and saying that we will remember, also in all caps.
Oil not moving much on this, but yields are taking flight. We're up by 11 basis points on the front end. 10-year yields, those go up by 8 basis points. So a reaction with maybe more expectations for higher inflation. Coming up, we speak with Kate Moore.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Dani Berger. Stocks headed for a fourth weekly decline, the first time they have done that in over a year.
Coming up, Brent heads for a weekly gain as the U.S. weighs a potential move on Iran's key export hub, Kharg Island. And we are getting reports as well that the U.S. is sending another 2,000 plus Marines and 3 warships to the Middle East.
And we're going to get insight on how CEOs are viewing that. We're going to speak with CEOs of one of Europe's biggest defense contractors, plus Mexico's finance minister on the oil impact.
And war-driven turbulence meets triple witching. Wall Street braces for $5.7 trillion in options set to expire. The MLive team on the Bloomberg terminal notes option traders are more likely to be forced to be net sellers to hedge their positions during the war. And Bloomberg macro strategist Michael Ball joins us now. It's a fascinating, if complicated, story. Simon White has a great piece out on the MLive team. But the bottom line is, if this market falls, typically options dealers buy to help us from falling too far, or if the market jumps, they sell to help us from jumping too far. Now we've got an amplified, both going in the same direction kind of move.
Yeah, so we went into this whole thing well hedged, which has helped to keep the tape together, keep the SPX sort of in this tighter range. We're starting to now break down a little more as we get below or go closer to the 6,600 area. There's a more fluid situation where dealers were forced to sort of chase moves. This OPEX will probably make that worse, because what's going to happen is you're going to have to choose to either hold on or roll your more expensive hedge now or sell your outright cash long. So that's probably what we're going to be looking at in the next couple of weeks. Now, everyone this week so far has monetized a lot of these hedges, which we've seen the VIX, for example, yesterday falling while we still saw spot going down. We'll see if this dynamic continues. If it doesn't, then we're going to find new lows.
This is like when Dan Zwirn joins us. My head is spinning. I don't know what I just heard.
So this might make you repeat yourself, but just the dynamics we're looking at. I was looking at various notes coming out. $64 billion has been sold out of SPY and the Qs over the past 3 months. That's nearly double the previous decade's extreme. Of course, they're bigger funds now. But still, you also have Goldman saying that Thursday saw the most long-only investors across their trading floor sell since they began tracking it in 2022. And then you have the National Association of Active Investment Managers. Their index shows exposure selling down 40% of their book over the past 3 months. That feels like massive selling. And an index that's like, meh.
Exactly, and that's what's actually be nice, because retail is still holding this up, where institutions, whether they're systemic, long, short, or the macro guys, have sort of already, because of the AI angst, because of the credit worries, we're already sort of degrossing, denetting, having a bigger short book. To add to Goldman, their short macro book, or their short macro like meter, is basically at all-time lows, 97 percentile negative there. So people are very crowded into shorts, which gives us opportunity for a squeeze. Of course, we don't know what that catalyst would be, given the Iran situation is not clear at all.
All right, if you want to know more about negative gamma, definitely type MLIV
I do.
On the Bloomberg terminal. Michael Ball writes for that team, and it's imperative, I think, right now to be following this stuff that closely, that deep in the weeds. One person who definitely has been doing that for a couple of decades now is Kate Moore, Citi Wealth Chief Investment Officer. And Kate, we just had a red headline cross the Bloomberg terminal that traders are now pricing in a 50% chance of a Fed rate increase by October. Even I know that would be a horrible idea in this environment, right? I mean...
And seems highly unlikely. In fact, just yesterday, we were kind of exploring the moves in the short end of the curve and the change in pricing. And we basically have been saying for a while, I know there are lots of voices at Citi, but our view has been the market was too sanguine, frankly, and was thinking that there were going to be too many cuts in 2026. So that's been a consistent message from us for the last 6 months. But now we feel like the pendulum has swung too far in terms of the expectation that the next Fed move could be a hike instead of a cut. There's so many other dynamics, people, politics, the labor market. But as a result of this, we took this opportunity actually to add to some of our short duration positions yesterday. And that was a call that we made, and basically reallocating a little bit out of EM debt, which had very, very little moves, frankly, since the start of this crisis, still like in the 5th or 6th percentile in terms of spreads over the last 10 years, and instead reallocating some of that money into the short end, where we think yields rose much more aggressively than the economic fundamentals and the policy outcomes would suggest.
It is stunning to look at the sensitivity of the rates markets. For example, it looks like they've taken this next leg higher over the headline Matt was talking about the Wall Street Journal saying that more warships are being sent to the region. So you get 2-year yields up 13 basis points, 10 years are up 10 basis points. Oil prices, by the way, haven't changed on those headlines. What are the greater ramifications, even if we're not going to get a hike from the Fed, of just that type of funding market volatility? Do you expect that to spill out into wider macro markets?
Yeah, well, look, I want to go talk about sentiment here for a moment because it comes in with an earlier conversation around what's happening on the option side, which is, I think a lot of people were paralyzed even before this Iran crisis. I think even people were paralyzed, not just because of questions around AI and private credit, but just because of like the duration of this cycle. And there were so many cross currents in terms of the macro. I like to say it was a little bit of choose your own adventure. You could pick whatever economic data you wanted to tell the story that supported your position. So we come into this, people are sort of neutral in terms of their overall positioning. They've been looking for big drawdowns. And even despite all this geopolitical shock, we haven't really gotten that. So, now we're in a position where we expect more volatility, where the likelihood that inflation is peakier and spicier for longer is very, very high. And everyone's like, I don't know what to do. So I think we're going to see more people try and look to broaden out their hedges, but we know that they're really expensive on both tails.
How do you keep a cool head, Kate? And I mean, there have been so many instances in the last 12 months where you could have been freaking out about a new thing each week.
Yeah.
But I guess part of your job is when everybody is fearful, you can't be that fearful. Or I mean, it's too easy to be super bearish all the time, for example. How can you avoid that?
Yeah, look, and sometimes some of us have been trained on the macro side, would have a bearish tilt. But I think, as you guys know, I'm kind of macro equity, so I like to take a little bit of risk as well. And the thing that's, gotten me sort of grounded and kept me in the equity market has been that the fundamentals are really strong. Unlike some people that were really worried that there would be no significant earnings outside of AI or that AI earnings would take down the overall market, that's not what we're seeing at all. Their vision story is still really positive. So I stay grounded in the fundamentals and also spend a lot of time trying to talk to companies or listening to what companies are saying. And the message they've been giving has been constructive. But I will tell you, Matt, another thing I do, I spend a lot of time with my dog. She doesn't really care about the volatility of the markets, and that helps to calm me down.
What kind of dog?
She's a golden retriever.
Oh, that's like the best you could have to make you happy and calm in these current times.
Yeah, she's like, what oil vol, Mom?
So as you look at the market and things start to sell off, you mentioned that you started to add it in the front end for U.S. rates. What else are you looking to adjust as market volatility peaks up?
Yeah, so one of the things we've been watching, I think, like a lot of people, is frankly the drawdown in European and emerging market equities relative to the U.S. These are obviously two places where the economies and the markets are much more sensitive to higher oil prices, to more challenging inflation environment, and frankly, the growth outlook may need to be downgraded. We have continued to like U.S. large caps as the anchor in portfolios. That's no big surprise. I think a lot of people are in that space. But many people were adding aggressively to European equities last year, leading to that massive multiple expansion, not fundamental, but multiple expansion. And we've seen twice the drawdown in European equities relative to U.S. large caps since the start of this year. And I think we have to watch that a little bit more closely. I have to say, even before this Iran crisis, we thought the fundamentals were unlikely to catch up with that multiple expansion we experienced in 25. So I think that's on my watch list. That's my number one.
I saw a headline. So gold is headed for its biggest weekly loss in 6 years. Gold's dropped every week since the U.S. and Israel attacked Iran. And I thought it was that's hard assets, low obsolescence, complete, right? So
totally.
What is happening here?
We have a chunky position in gold, and it did very well for us over the course of 2025. We added to it opportunistically. And of course, it hasn't performed as well as we would want it to during these moments of risk. I think a lot of it, Matt, has to do with the fact that there was, pretty full positioning going into this crisis.
That's fair, at well over $5,000.
Yeah, I mean, people were adding to it all their portfolios, whether or not they were multi-asset. It was being used for a million different reasons. And so, this is just kind of a moment of reckoning and a little bit of moment of I think people readjusting their expectations for gold. That said, it still plays the portfolio position we need it to play. We're not adding to duration. we're not adding to some other parts of risk, and we want the gold to balance things out. And we still are up on the year, but we're going to be watching the positioning and sentiment very closely because that's going to really dictate the near-term price movement.
By the way, as we're making a round trip in assets that seem to have become controversial as of late, we have to end on private credit. I think it's only fair. David Solomon had his CEO letter out saying, it's clear what we're seeing is just that there is a credit cycle and that it's on its way. How are you viewing what's happening in the sector? The constant headlines, is this just a credit cycle finally coming for the sector? Or are there some real concerns that should make investors think twice before investing in the asset class?
Yeah, the thing I'm most focused on is the size of the doors, right? And the size of the exits for all of these funds. You know, in an environment where people are afraid, but then can pull their money out, you know, things settle pretty quickly. But the more the sort of doors narrow and the exits get smaller and smaller, I think the more it feeds into a negative sentiment when we have all of this other stuff going on in the background. And of course, we've had lots of private credit managers come out and assure us, hey, we have a great diligence process. Hey, we've checked the asset quality of all the companies we invest in and we feel good about it. But I don't think that alone is going to be enough to calm sentiment. And so this is what I'm going to be watching, is like, how much do we kind of close the exits? And what does that mean in terms of people are trying to de-risk their portfolios? Where do they go to sell if they can't reduce their risk in this space? And then just the last thing I'd say around the software side in the private credit, that's what everyone focuses on. Okay, these software companies, you know, their business models are getting disrupted by AI. By the way, spoiler alert, every company, every industry is getting, you know, their business models disrupted by AI. It's fair to ask whether some of these small and mid-sized companies that, you know, these private credit company funds have been lending to are all going to be in the strength position that large cap companies with a lot of capital and a lot of investment spend are in. So that's the big question. I don't think it's the software headline. I think is a red herring.
By the way, on the doors, does this just demonstrate that this was always going to be a fundamental mismatch? That these types of products are illiquid and they were sold as semi-liquid, and that's perhaps not the entirety of the truth.
To people who didn't really get what's happening, like because like CalPERS or the Canadian, you know, teachers pension fund, they get it.
Right.
It's the others, the retail, I guess, high net worth individuals.
Yeah, and I'm very happy to say that that was not the message we were giving to our clients. We were basically saying this is a illiquid and longer duration asset, so we feel comfortable with the way that we positioned, but we also understand the angst. I think it's going to be really clear that all of these types of funds need to specify the risks and the liquidity constraints to all of their potential investors going forward. But I think the sentiment's going to be a little sour for the time being.
Kate, so wonderful to have you on. Thank you for spending your Friday morning with us. That is Citi Wealth Chief Investment Officer Kate Moore. A check on markets this morning. Again, the latest headline coming out of Iran from the Wall Street Journal that the U.S. is sending 3 more warships to the region. That has forced equities to their lows of the morning and bond yields to the high. 2-year yields up 12.5 basis points. S&P down 0.8%. The Nasdaq down by 1.9. And the interesting thing of all of this is that Brent crude is barely moving. This impact is being played through yields with now 50% odds that we get a hike.
Yeah, and by the way, in case you needed a distraction, and you know, sometimes distraction is a great tactic. The New York Times says the Justice Department is examining whether President Gustavo Petro of Colombia has ties to drug traffickers. So add another country to your list, I guess. And the White House, according to the New York Times, is suing Harvard over accusations of anti-Semitism.
Okay,
so there's still other stuff going on in the world.
There indeed is, but speaking of other stuff going on in the world, don't look away at these things. These are the single stocks moving this hour, and they matter, Matt. FedEx says that the war in Iran won't have a material impact on its business. It also raised its profit outlook up just under 2%.
Novartis agreed to buy an experimental breast cancer drug from Synovation Therapeutics for as much as $3 billion.
Meanwhile, satellite imaging firm Planet Labs surging after revenue in its 2027 outlook topped estimates, up 28%.
Coming up, JP Morgan targets banker burnout. The bank is, well, that's what it says it's doing. The bank is launching a program to monitor junior bankers' hours because it doesn't want them to work too much. But it's watching is the point. So stay tuned. This is Open Interest. Let's get to high interest. Look what's making headlines around the world. Big tech just entered the credit risk big leagues. Meta, Alphabet and Microsoft are joining the CDX investment grade index. The move reflects a surge in demand to hedge AI-driven debt as hyperscalers ramp up borrowing for AI infrastructure. Their credit swaps are now among the most actively traded, reshaping how investors gauge risk in corporate bonds. Unilever is weighing a $33 billion sale of its food arm, including Hellmann's Mayonnaise, to McCormick, the spice monster. I mean that in a good way. The move would allow Unilever to exit big food and sharpen its focus on beauty and personal care, but this mega merger could get messy. McCormick's smaller size means heavy financing, high debt, and a complex global integration, but all those great things would be on the same shelves, hopefully. JP Morgan is piloting a program that will track junior banker workloads by comparing reported hours with digital activity like calls and keystrokes. The bank says it's about awareness, not surveillance, as Wall Street faces ongoing scrutiny over long hours. But, Dani, I think it's probably at least partially about surveillance, right?
You know who we should ask about this? Catherine Doherty, our Bloomberg finance reporter who joins us now. Is this just a friendly, we don't want you to work too long, so we're monitoring your hours?
So it's interesting. I think that this helps the bank with accountability, right? They're going to be looking at this. It's purely another data metric. In the same way that at the end of the week, you look at your phone and you get a report that says how many hours you've engaged on certain apps. That's essentially what they're trying to compare this monitoring system, which is in pilot phase now. It's going to be rolled out more widely in the investment bank. But that is truly the unit that the hours do matter. This is where we've seen reports not just at JP Morgan, but across Wall Street, investment bankers having to put in so many hours working on deals, pulling over all-nighters, and that's impacting their well-being, mental health. So this is a topic that comes up time and time again. This is just a tool that the bank is implementing to again, hold themselves and their employees accountable for the type of work that they're asking them to put in.
But I guess, I mean, they're just monitoring, if you're just monitoring keystrokes and calls that I make on my, landline at work, no big deal. They're not like watching Instagram and Snapchat.
Correct.
Are they?
Well, I'm assuming that if you talk to any of these banks, they hope that their bankers aren't spending time on Snapchat and Instagram.
They must know that surely they are.
But surely they're taking breaks. But that is getting to the heart of the question, Matt, is that what they will be monitoring is the output of their employees specific to the work that they are doing. Not anything to do with how they're spending their time personally, if they're taking a walk in the middle of the day or taking a phone call that's not work related. That could be on their personal phone. This is all having to do with work that the bank is asking its employees, and specifically within the investment bank.
I thought that they were all armed with AI and were much more efficient anyway and would have to work less or something along those lines.
But alternatively, you can think about AI is making people more efficient. It's just also helping people work faster. So that might mean that the workload just becomes more and more. It's a snowball effect where, yes, you might be more efficient, but because you finish one assignment earlier than you thought, you're just moving on to the next assignment. So it doesn't necessarily mean that you're cutting down the hours overall.
Maybe they're using AI to monitor these bankers. Do we know?
It is a tech, it's a software, but I think that it's probably, and this is what they compared it to, is the summary, again, that you get on your phone at the end of the week. So I think it's a very similar system, and it's monitoring the keystrokes and things that are all within the bank's technology and system. It's not having to do with personal use.
What's your daily usage? Dani, what's your screen time?
Oh, it's like 5 hours.
Yeah.
Mine's 4 to 5 each week.
I'm right
I try
there
to cut
too.
down.
And my wife and I are constantly, she's like, I'm on my phone less than you are. And then we compare, and I
Wait,
always
by the
lose.
way, I assume as an employee of any company that all of my tech usage and all of my work is always being tracked. Like, I wonder how even surprising this is that JP Morgan would do this, or that they're not already doing some version of it.
I don't know if it will be that surprising, but the fact that it is something that is becoming more formal, it's just now it's something. I think the question that really should be asked is whether or not this system will be used at the end of the day to qualify and quantify the type of work so that it comes down to at the end of the year when you're talking about your bonus,
Yeah.
will this number get factored into that?
That's
I
a
think
great
that might
point.
backfire.
So it's like you spent 3 hours moving one logo on PowerPoint from one
Correct.
corner to the other corner. Therefore, we're not giving you
Now,
as
we
big of
don't
a
know if it
bonus.
goes into that type of detail, but so let's say you're trying to negotiate a higher base salary or bonus at the end of the year. You could say, hey, look, my monitoring system is saying I'm putting in 100 hours a week. So really, when the bank is touting this as something that's meant to save their employees, to account for overwork, not or overuse, I think that it could also be used at the end of the day with qualifying the type of work that their employees are doing as well. So it might backfire, but it's too soon to say.
That's a good point. Maybe it empowers employees. That would be a wonderful outcome. Catherine, thank you so much for joining. Catherine Doherty from our banking team. Still ahead, we're going to speak to the CEO of one of Europe's biggest defense contractors as the Iran conflict drives demand, and Mexico's finance minister on the oil shock. This is Bloomberg Open Interest.
All right, let's get a check on the stock market right now using the move screen on the Bloomberg terminal. I think it's the most dynamic way to look at an index. And the trend, if you're long, the trend is not your friend. Today, you can see that we continue to come down, 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 with only 120 stocks gaining, and they are not the biggest ones. Okay, ExxonMobil is pretty big, and Telephone, Wells Fargo. But if you look on the losing side of the ledger, you'll see the biggest companies in America. So Nvidia is down, Microsoft is off, Facebook is down, Google is down, Tesla, Amazon, Broadcom, the entire Mag 7 is off today, and that's why you see losses that are accelerating. In terms of the sectors, energy, it looks just like that screen. Energy is doing well, and everything else is down, with financials very little change. So even real estate, utilities, consumer discretionary, which you normally think about as defensive, are selling off bigly. Coming up next, we're going to hear from Patrice, Caine, the CEO of defense contractor Thales Group, as the Iran war escalates. This is Bloomberg Open Interest.
You're looking at European defense stocks. They are stalling. There's this question over whether profits can keep pace with valuations. However, the focus is now on an additional war, the war in Iran, and what that means to defense companies. Joining us now is Patrice, Caine, chairman and CEO of Thales Group, one of Europe's biggest defense contractors. Patrice, thank you so much for joining. And I was just looking at your financial statement. The Middle East accounts for about 6% of your revenue for the entirety of last year. What's changed for you as this war in Iran has broken out? What have you heard from your Middle East customers?
First and foremost, we have, I would say, put all our employees in a safe place. Sorry to say so, but that's the most important point for a company. Then, of course, many customers in the region have asked us to help them to support their equipment. That's the first outcome. And second one is also to sell or to supply, new equipment, and typically radars. That's super important for them to protect their airspace, and also effectors, missiles, rockets, or whatsoever, to defend themselves against the Iranian attacks.
So I imagine there's a government regulator that tells you which countries you can sell to and which countries you can't sell to. Is that the case, and how often does that list change?
In fact, this industry is very specific, and that's normal, by the way. It is super controlled, and that's normal. So when we export from a given country, from the US typically, the US government tells us if we can or not export. If we export from France, from UK as well. So it's really first and foremost a governmental decision to authorize you to export or not, and then you proceed further or not.
From which country do you export the most? I mean, is the US your
Historically speaking, you know, the most, I would say, significant footprint is in Europe still. So we do export a lot from Europe, from France, from the UK. That's probably the main countries from which we support what we call export customers or overseas customers.
There's so much demand now because you add the war in Iran to already the war happening in Ukraine. I was listening to an interview with Rheinmetall CEO, who I'm sure you know well, saying that if this lasts another month, I think we will nearly have no missiles available. Are you seeing something similar? Is there a serious shortage of the ability of the U.S., of Middle East, of these nations to combat drones in the sky, for example, from Iran?
It's difficult, to say whether there will be a lack of missiles or not. By the way, this piece of information are classified.
Sure.
And it's also normal, to protect the military edge you have by not disclosing the reality of your forces, number one. Number two, to deal with these new types of threats, typically drones or UAVs, indeed, you need cheap, if I may, cheap effectors. And in particular, what we do from Belfast in the UK, I mean, it's simple missiles, much, I would say, affordable than typically a Patriot missile, is much more suited to deal with this type of threats.
Are those almost ready for the battlefield? Because it does feel like we're shooting down paper planes with golden arrows right now.
Those missiles, of course, are ready. By the way, we have multiplied by 4 the production in Belfast, just to give an example. We've done the same for our production of rockets. It's even cheaper, a rocket. We've multiplied by 4 in Belgium, in France. So if needed, we can go even further.
So just to underline that, as far as I understand it, and there's been a lot more research done on this by people like me in the last few weeks, that you've been doing this your whole career, but we are depleting our weapons cache at an uncomfortable pace right now. And when I say we, I mean the US and NATO. So that's one issue that we have. The other issue is that our weapons are so much more expensive compared to the weapons that our adversaries are using. So there's two kind of asymmetries here that are problematic. How quickly can we change those things?
No, you're perfectly right. This observation is perfectly right. Hence the fact that we really need, to adapt or to use effectors, as we call them, that are, I would say, much cheaper. You can produce in greater quantity. You can produce much quicker as well because they're simpler. And that's what needs to be done ASAP. That's what we've started to do, by the way.
And by the way, that's a concern that the president raised before we attacked Iran. I mean, he wants certainly U.S. defense contractors to do things faster.
Absolutely. And by the way, we are part of the Patriot missile. We supply some of the electronics. And we have been asked really to ramp up steeply our production to support the production of the full missile. This is something that is clearly at play at the moment.
Do you think that there are any other holes that the past 2 weeks have exposed in Western militaries? Are there any programs that you've involved in beyond this that you've started to ramp up and really lean into?
I think, let's say, the Western world has everything in hand to cover every type of threats. Maybe it's really true in Europe. We are focusing on the Middle East currently and the US, because the US is engaged in this war. But looking at a little bit at Europe, this part of the world has clearly underinvested in defense for decades. Take Europe, since the fall of the Berlin Wall, we Europeans all thought that we were living in a piece of area forever. It was naive, clearly, and the outbreak of the war in Ukraine was such a shock for these countries that they rediscovered the fact that we need more. We need to get equipped. We need to protect our people. So at the same time, these countries need to compensate decades of underinvestment and also support countries which are at war. So there's a kind of double challenges that they need to meet at the same time.
Are the parliaments around the world facing up to the fact that they need to spend more money? Because it wasn't just peace that was helpful to Europe spending less. It was the fact that the U.S. spends 66% of NATO budget. We spend more money on defense than the next 10 biggest economies combined. We spend 37% of global defense spending. So are the others going to try and catch up?
Absolutely. That's why during the latest NATO summit last year, it was decided by all the European states, to the exception of Spain, by the way, but all the others have committed to grow their defense spendings in percentage of the GDP. That's what is used to measure the level of efforts that you dedicate to defense, from 2% in average up to 3.5%. That's a huge effort, but that's the commitment of all the European countries to take their destiny in hands, as President Trump has suggested, to protect themselves. They are still part of NATO. NATO is still super important. But European countries have taken this commitment, yes, to take their destiny much more in hands than it used to be the case before.
Are there assets that no amount of money can get you quickly enough? I mean, I think of rare earths, right? Do Western defense contractors have enough access to rare earths because they're necessary for especially the targeted weapons that we use?
For the moment, yes. Now, no one can tell what the future will be, but for the moment, yes. And by the way, you could raise the topic as well for chips, components. It's not only rare earth. It's all the entrants that we need in our supply chain at the end of the day to produce all these equipments.
Fascinating. Thank you so much, Patrice, for coming in. Patrice Caine there, Chairman and CEO of the Thales Group. Let's take a look at what's going on in markets right now. We had seen a turn lower, and it persists. The S&P now down 0.8% at 65.51. The NASDAQ down more than 1 full percent. As we just showed you on the move screen, the biggest companies in America are on the losing side of the ledger. All of the Mag 7 companies trading lower today. The 2-year yield and really yields across the Treasury curve are rising pretty dramatically here. I mean, 14 basis points on the 2-year yield, and we broke the headlines earlier that markets are now pricing in a more than 50% chance of a rate hike, astoundingly. These are serious pieces of news that are moving financial assets in a big way. So 393 on a 2-year yield when our Fed has an upper bound of 375. You can see Brent there moving a little bit, but it's interesting as we get reports that the U.S. is sending 3 more warships to the Middle East and more than 2,000 additional Marines. You don't see an increase in the crude price on today's trade.
Perhaps some of it was already priced in there, but it is notable just to underscore the extent and the magnitude of this move. A 13-point basis point move in the front end of the Treasury is the biggest move that we've seen in a single day since Liberation Day. That's how this rates market is treating what we've gotten over the past 2 weeks. It is a Liberation Day type seismic event, and yet other markets were down less than 1%. For the S&P 500. Maybe there's a lot of hedging, what you will, but it is, again, a lot of volatility in this funding
market. By the way,
market.
as I said, across the curve, I mean, the 10-year yield is also up 13 basis points to 437, 438.
And by the way, it's a bigger reaction today than we've seen in Europe. Perhaps that's because Europe has already seen a really big move in its bond market. German 10-year yields up about 6 basis points. Those are now at the highest since 2011.
15 years ago, it's been that long since German 10-year yields, the Bund, has been this high. Here's the U.S. Treasury curve, and you can see the moves higher are significant. Coming up, we're going to look at the impact of elevated crude prices on Latin America's second largest oil producer. Mexico's finance minister, Edgar Amador, joins us next. This is Bloomberg. The war in Iran has intensified and strengthened the dollar against all of its major trading partners, but the Mexican peso has fallen more than 3% against the greenback in the past 3 weeks. Meanwhile, the Mexican economy, like every other economy in the world, is learning to deal with the rising price of oil. And that's, I think, a double-edged sword, it's fair to say, for Mexico, because it is the U.S.'s largest customer for crude exports, the U.S.'s largest customer of nat gas exports, but also one of the biggest producers itself of crude oil in on the continent. Joining us now is Mexico's largest banking convention. Mexico's largest banking convention is the finance minister, Edgar Amador. Really honored to have you here. Thanks so much for joining us. Talk to us about the effects of higher crude prices, because you make a lot of oil, but you also buy a lot of crude products.
Right, Dani, thank you for having us this morning. Absolutely. Mexico is more a manufacturer exporter than an energy exporter, as you were precisely saying. So we have a relatively balanced effect on our domestic fiscal front. We are exporters of oil, but we also import quite a bit of energy. But in the balance, we have a net, almost neutral effect on our fiscal side. And for us, that is very important because we're always watchful of what investors, markets, and rating agencies have to say. So we are estimating that we are going to be able to more or less offset and to accommodate the impact on our fiscal side and also for the consumer. We have a stimulus package for domestic consumers, so not every increase in energy prices at the international markets would be passed through domestic consumers. So I think the quick answer for you would be that we would have a relatively neutral and balanced effect from our domestic and fiscal
Minister, is there a price or a level or a duration at which oil needs to stay elevated or higher, at which that changes and you need to rethink energy strategies?
Well, it's not only level, but also the duration, Dani, of this impact. We believe that what futures markets are telling us is that this will be relatively short-lived, and they will be temporary, and we should be able to accommodate both the fiscal, the price, and the economic effects. We would be more concerned if this turns out to be more prolonged and the effects on prices would be more long-lasting. But at this current level of oil prices and energy, I think for the moment we would have a close to neutral effect on our fiscal balances and our economy.
I wonder the effect of the drop in the currency. The peso has dropped an extraordinary amount against the dollar. Does that give you a tailwind in terms of economic growth? And I know that you're trying to pass an infrastructure bill right now also to stimulate growth.
Well, the peso has been one of the most one of the gainers in the currency market for the last 12 months. So what we have seen recently under this energy prices situation is a relatively modest pullback from what we've seen over the last 12 months. So we are, content where the peso is trading. It's a free float regime for our currency, which is one of the most liquid in the emerging market concern. So overall, over the last 12 months, the peso has been performing very well. And I think what we are seeing is the currency market accommodating the shocks in the energy and financial markets. Sure, we have seen some volatility on our currency front as of late. But over the last 12 months, the peso has been doing okay, and we believe that this framework, which also is accompanied by relatively stable performance on the interest rate market, our bond markets have sold a little bit over the last couple of weeks, but it's down markedly from last year. So I think this mix that we are facing, we're facing a relatively stable currency and bond markets compared to other economies.
Right.
Fit well for our investment strategy in infrastructure.
Minister, we also have talks for USMCA's preliminary review ongoing in Washington, D.C. this week. Are you confident that it will be extended?
Yes, we are. The teams have begun talks in Washington, D.C. And if you take a look at Mexico's trade balance with the United States over last year, we became the United States' largest trading partner, both on the export front and the import front. Mexico increased its market share in the United States. So despite the headwinds, despite the headlines, Mexico's and the United States economic integration continues to move forward, and I think this testifies to the increased flexibility and prowess of North American manufacturing. We are very optimistic that both countries will end up having a very good trade deal.
Minister, thank you so much for joining us. We appreciate your time. That's Mexico Finance Minister Edgar Amador. Coming up, the Pentagon wants an additional $200 billion to fund the war in Iran, but Congress isn't yet convinced. We're going to have the latest from Washington, D.C. You're watching Bloomberg Open Interest.
Let's look ahead at what's going on in markets next week. The CERAWeek Energy Conference kicks off in Houston Monday. Tuesday, we get the latest read on manufacturing with PMI data. Also Tuesday, Bloomberg Tech goes live from the Hill and Valley Forum in Washington, bringing together executives and investors to discuss innovation and industrial strategy. Thursday, G7 foreign ministers meet in Paris with Middle East tensions in focus. And Friday, Carnival, the cruise line. Earnings reports, and we get University of Michigan consumer sentiment as well. It's great that those two things happen on the same day because I feel like they're perfect for each other.
Yeah, get a good read on the consumer. I feel like usually Carnival is more indicative of what the consumer is doing.
Yeah.
And they're spending and going on cruises.
Yeah.
It's pretty much what we're seeing. Another development that we're going to be watching in Washington next week, the Pentagon asking for an additional $200 billion to pay for the war against Iran. The supplemental bill would have to be approved by Congress. For more perspective on what that means for market and policy, we're joined by Nathan Dean of Bloomberg Intelligence. Nathan, what's the likelihood that President Trump gets his extra $200 billion for this war?
So I don't think it's going to happen right now, but we'll have to see what happens later this summer. So the Pentagon, obviously, like you just said, is asking, or is reportedly asking for about $200 billion. But we should note that this is a floor, not an actual amount. The request will have to come from the White House, and we think that that number is going to be increasing. So if you're looking at this from a modeling perspective, and if you're looking at the defense contractors, what you need to know here is that most of this money from the Defense Department would be geared towards anti-air defense systems, think anti-drone, counter-drone technology here. But then when it gets to Congress, what we're seeing from people on Capitol Hill, both Republican and Democrat, they're saying, A, we may be interested in attaching more, think $15 billion in farm aid, and B, let's actually wait and see what the actual need here is, because there are lawmakers who are thinking, you know what, maybe we should do this via the appropriations process. They have that till September. Or maybe should we do this during regular order, which means you need 60 votes, or reconciliation. The reason why I'm trying to confuse you is there's a lot of pathways that this can go. But the thing for clients to note is we don't think serious debate on this bill is going to happen probably until around Memorial Day at the earliest.
Well, the president is implying that his justification for going to war in the latest Truth Social post, but in many, is that he thinks Iran was, I guess, on the cusp of building a nuclear weapon or some such accusation. But we don't have a formal justification or formal objectives here. Does Congress need to know that before they spend another 20%, 30%, 50% on defense?
So if you're on the Democratic side of the aisle, absolutely. I mean, the Democrats are going to be asking a lot of tough questions, even those that would be somewhat supportive of this idea of paying more for the troops. But, you know, the thing is that the Democrats are going to have another vote, or they're going to at least try and push another vote next week on a war powers resolution, and that most likely will fail. President Trump has significant support amongst the Republican side. But, you know, there will have to come a point 60 days after February 28th, so April 29th or May 29th, depending on what the White House does, is that the White House will then have to go to Congress for an authorization of use of military force. The last time Congress declared war was actually back in 1941. And we think President Trump will actually take steps to try and negate that vote, or at least rely on either existing AUMFs, or at the very least, there is a tendency for President Trump to actually say they will declare victory. The last time I looked at the prediction markets, there was about a 76% chance he does that before June 1st.
All right, Nathan, thanks very much. Nathan Dean there of Bloomberg Intelligence talking to us about the spending on the Middle East war, the third in my experience. Coming up on Monday, Amanda Agati of PNC, Sitara Sundar of JP Morgan Private Bank, U.S. Ambassador to the EU, Andrew Puzder, and the CEO of Ducati North America.